The US dollar has been the world's reserve currency since 1944. That arrangement is fraying. Not collapsing, not imploding, but fraying in ways that compound over time. The dollar's share of global reserves fell from 71% in 1999 to 56.8% at the end of 2025. Gold rose from about $1,600 an ounce in late 2022 to a record $5,318 in January 2026. And the President of the United States said that's fine. By the end of this video, you'll know exactly what a weaker dollar cost you, and the one move that protects you if the leak gets worse. If you've traveled abroad recently, you already know what a weaker dollar feels like. The hotel room in Lisbon that cost 120 euros last year now costs you more in dollars, even though the price tag in euros hasn't moved. A weaker dollar means your paycheck, denominated in dollars, buys less of everything priced in another currency. Foreign goods on Amazon, imported electronics, European wine, and critically oil. Oil is priced in dollars globally, but when the dollar falls, oil producers need a higher dollar price to earn the same amount in their own money. The average American fills up about 36 times a year. A 30-cent per gallon increase from dollar weakness alone, across a 14-gallon tank, costs a household roughly $150 extra per year. That is real money, and it comes out of the same budget that pays for groceries and rent. Then there's the mortgage. Mortgage rates in the US track the 10-year Treasury yield, which is influenced by how much foreign money flows into US government bonds. When foreign investors get nervous about the dollar, they buy fewer treasuries. Fewer buyers means the Treasury has to offer higher interest rates to attract them. The 10-year Treasury yield stood at 4.55% in July 2026, up from 3.61% in 2010. If foreign demand keeps eroding, the monthly payment on a $400,000 house could jump by. Your 401k is also exposed, but in a more complicated way. A weaker dollar actually helps US companies that sell abroad because their foreign earnings are worth more when converted back into dollars. So you might see your stock portfolio go up even as your purchasing power goes down. Roughly half of American households have no direct stock market exposure, so for them a weaker dollar is pure cost with no offsetting benefit. The savings account angle is the quiet killer. If you have $10,000 in a bank savings account, earning 0.5% interest, and the dollar loses 3% of its value over a year, you've lost 2.5% in real terms. You did nothing wrong. You saved your money. But the currency you saved in is worth less, and the interest rate didn't keep up. Economists call this the inflation tax, and it hits people who hold cash hardest. There is one group that benefits from a weaker dollar: people who owe money. If you have a fixed-rate mortgage or student loans, those debts get easier to pay off as the dollar loses value. For most middle-income Americans, the net effect is probably negative, because the cost increases on essentials like gas and food hit harder than the diffuse benefits. This happened before. The last world reserve currency went through exactly this. Sterling became the world's reserve currency in the late 1800s, when Britain was the world's leading manufacturer, its biggest trader, and its dominant naval power. By 1913, over 60% of global trade was invoiced in pounds. London was the financial capital of the world. Sterling was backed by gold, and Britain owned the largest gold reserves on Earth. This is the same setup the dollar enjoys today: economic dominance, military reach, deep financial markets, and a currency everyone needs to do business. The first crack came with World War I. Britain spent roughly 25% of its national wealth on the war, borrowing heavily from the United States. By 1918, Britain owed the US about $4.7 billion, roughly $85 billion in today's money. Gold flowed from London to New York, and the dollar began displacing sterling in central bank reserves in the late 1920s. This is the detail most people miss. The shift started quietly, through private decisions by banks and investors, not through a treaty. Then Britain made a fateful error in 1925. Winston Churchill, then Chancellor of the Exchequer, restored sterling's pre-war gold parity at $4.86 per pound, overvaluing the pound by about 10%. The result was deflation, unemployment, and a loss of export competitiveness. John Maynard Keynes attacked the decision, arguing Churchill was trying to restore the past instead of facing the present. The parallel to today is uncomfortable. The US dollar has been persistently overvalued for years. The Great Depression finished the job. Facing a run on sterling and a collapse in gold reserves, Britain abandoned the gold standard. Countries that had kept their reserves in sterling took losses. World War II was the final blow. By 1945, Britain's national debt exceeded 250% of GDP. The country was bankrupt. At Bretton Woods in 1944, the US controlled 2/3 of the world's gold and insisted the dollar anchor the new system. The dollar was pegged to gold at $35 an ounce, and every other currency was pegged to the dollar. Sterling was demoted. But the real moment came in 1956, the Suez Crisis. When Britain, France, and Israel invaded Egypt, the US simply threatened to sell its sterling holdings, which would have crashed the currency. Britain backed down within days. The message was clear. The reserve currency was now the dollar, and the country that issued it could dictate terms to anyone. Sterling took about 40 years to lose its crown. The dollar's decline, if it follows the same arc, is still in the early chapters. The dollar's current troubles have a specific starting point, April 2nd, 2025. That was the day President Trump announced his Liberation Day tariffs, a sweeping set of import duties on goods from dozens of countries. Foreign investors sold $63 billion in US equities between March and April 2025. The dollar index fell 8% over the course of 2025. By January 2026, Trump publicly shrugged off the dollar's depreciation, saying a weaker dollar was good for business. The conventional wisdom for decades was that the dollar's reserve status made it bulletproof. What changed is that the push came from inside the House. The Atlantic Council identified 3 competing factions within the Trump administration, each with a different view of what the dollar is for. Trump himself sees the dollar as a symbol of American nationalism, threatening 100% tariffs on BRICS countries that try to build alternative currency blocks. Stephen Moran, chair of the Council of Economic Advisors, sees the dollar's reserve status as a burden and has proposed deliberately devaluing it. Treasury Secretary Scott Bessent and Fed officials see dollar-backed stablecoins as a way to reinforce the dollar's primacy. These views are not just different, they are contradictory. You cannot simultaneously threaten countries for leaving the dollar and work to make the dollar worth less. The gold market noticed first. Gold surged to a record $5,318 per ounce on January 29, 2026, before pulling back to around $4,044 by July. The Atlantic Council described a vibe shift on the dollar, arguing that this time the political forces weakening it apply far more broadly than sanctions risk ever did. The perception that US policy is wildly unpredictable has spread to traditional allies, not just adversaries. Then came the China signal. On February 10, 2026, the Atlantic Council reported that Chinese regulators had been urging domestic financial institutions to limit purchases of US treasuries. The leak came within a week of a published Xi Jinping speech calling for the internationalization of the yuan. China's central bank governor, Pan Gongsheng, stated in a summer 2025 speech that multipolarity was the government's goal. China cut its treasury holdings from $1.3 trillion in 2013 to $682 billion by November 2025. But total foreign holdings of US treasuries actually hit a record $9.35 trillion in November 2025. The decline in the foreign share, from about 50% in the early 2010s to 30% today, mainly reflects the rapid expansion of US government debt, not a collapse in foreign demand. Meanwhile, reports surfaced that the US had settled parts of its trade deficit with China in physical gold in 3 of the last 4 months. If you're getting something out of this, hit subscribe. It costs you nothing, and it tells the algorithm to show this to more people who need to hear it. Now, most people think de-dollarization is a dramatic event, countries dumping dollars, the dollar crashing overnight. The reality is more boring and more powerful. De-dollarization happens in the plumbing, in the systems that move money between banks across borders. When a Brazilian company sells soybeans to a Chinese buyer, the contract specifies a currency. For decades, that currency was almost always the dollar, even though neither country uses dollars domestically. The reason was convenience. Everyone had a dollar account. Everyone trusted dollar clearing. China now settles roughly 1/3 of its foreign trade in yuan, up from about 20% in 2022. Each transaction settled in yuan instead of dollars is a small leak in the dollar's network. The dollar's dominance is reinforced by SWIFT, the messaging system that banks use to send payment instructions across borders. When the US sanctions a country, it can cut that country's banks off from SWIFT, effectively locking them out of the global financial system. Russia was partially removed from SWIFT in 2022 after its invasion of Ukraine. The response has been a proliferation of alternatives. China built CIPS, which handles cross-border yuan payments. In 2024, CIPS processed over $26 trillion in annual business volume. SWIFT processes roughly $5 trillion per day, so CIPS is still a fraction, but it is growing fast. Then there's mBridge, a cross-border digital payments network connecting the central banks of Hong Kong, Thailand, the UAE, Saudi Arabia, and China. By November 2025, mBridge's cumulative transaction volume reached $55.5 billion, up from just $22 million in 2022. Russia and China now settle approximately 95% of their bilateral trade without dollars. None of these alone threatens the dollar, but the layers interact. Talk is cheap, data is not. The dollar index measures the dollar against a basket of 6 major currencies. It rose from about 79 in 2010 to a peak of 114.1 on September 27, 2022. Since then, it has fallen to 100.5 as of July 2026, a decline of about 12%. That decline is not dramatic by historical standards. What is different this time is the context. The decline is happening alongside a gold rally, a reduction in foreign treasury holdings, and a president who is comfortable with a weaker dollar. The gold versus dollar chart is the most visually striking. Gold rose from about $1,627 an ounce in September 2022 to a record $5,318 in January 2026, before pulling back to $4,044 in July. That is a 148% gain, while the dollar fell 12%. The correlation between daily dollar returns and daily gold returns was negative 0.39. When the dollar sneezes, gold catches a cold in reverse. Market participants call this the debasement trade. You sell the currency you think is being debased and buy something that cannot be printed. Foreign investors held about 15% of US treasuries in the early 1980s. That share rose to about 50% in the early 2010s, then fell to roughly 30% today. The decline is partly arithmetic. US government debt has grown so fast that foreign buying couldn't keep up. The dollar's share of global reserves has declined from 71% in 1999 to 56.8% in 2025. The euro holds about 20%, the yen 5.8%, and the Chinese renminbi just under 2%. The numbers tell a story of gradual erosion, not sudden collapse. The risk is that slow shifts can accelerate. The dollar's decline so far has been orderly. The question is whether this calm persists. 3 scenarios are worth considering. Scenario 1, slow grind. The dollar drifts lower by 2 to 3% per year. The reserve share falls to 50% by 2030, and the US muddles through with somewhat higher inflation. This is the most likely outcome, and it is roughly what the current data supports. Scenario 2, Trump's weak dollar experiment. The administration actively pursues dollar depreciation. The dollar falls 20 to 30% over 2 years. Exports get cheaper, but Treasury yields spike to 5.5 or 6%. Mortgage rates hit 8%, the housing market stalls, and the damage to confidence is done. Scenario 3, a confidence shock. Some event triggers a sudden loss of confidence. Foreign investors sell treasuries en masse. The dollar drops 10% in a month, and gold spikes to $7,000 or $8,000. This is the tail risk that keeps Treasury officials awake at night. The buffer is not infinite, and it erodes with each policy misstep. The dollar is probably not going to collapse. It is still 57% of global reserves, 88% of foreign exchange turnover, and the currency most of the world's trade is invoiced in. But probably not collapsing is not the same as fine. Here is what to watch. Watch the 10-year Treasury yield. It was 4.55% in July 2026. If it climbs above 5% and stays there, foreign investors are demanding more to hold dollar debt. Watch gold. Gold at $4,000 is a signal. Gold at $6,000 would be a warning. Gold at $8,000 would be a fire alarm. Watch the dollar index. If it falls below 90, imported goods are getting significantly more expensive. Watch what China does with its treasury holdings. What should you actually do? The boring answer is the right one: diversify. If all your savings are in dollars, in dollar bank accounts, in dollar bonds, you are making a concentrated bet on the dollar. An international stock fund, a bond fund with non-US government debt, or a modest allocation to gold gives you protection if the decline accelerates. If you have a fixed-rate mortgage, keep it. It is one of the best hedges against dollar depreciation. And if you have cash sitting in a savings account earning 0.5%, move at least some of it into treasury bills yielding around 4.5%. The smart move is not to bet against the dollar, but to stop betting everything on it. The dollar's 80-year run has been an extraordinary anomaly. Anomalies don't last forever. What would you do differently if the dollar dropped another 20%? Tell me in the comments. Subscribe for more.